Hello class, this is Dr. Fenton. In this video, we're going to talk about business valuations. Now I think this area is very interesting. It's a great career path. I believe business valuations would be an easier area to get into. Not that this area is easy, but an easier area to get into in your practice because there are a variety of needs for people who need business valuations. So let's get started. Chapter 16, Business Valuations. I want to stress the fact that in this chapter we're just skimming the surface of business valuations. This gives you a good basic understanding of business valuations, but by no means is this a full-blown course in business valuations. There are full courses available. There are seminars you can go to, books you can read, articles you can read, and so we are just barely touching the surface, but still we are going to learn a lot in this video. I do want to point out there are various certifications you can receive in this area. You can earn these. There is the Accredited Senior Appraiser, the Accredited Member, there's a Certified Valuation Analyst, and the Accredited in Business Valuation. And various professional organizations have these certifications available, and you need to, a lot of times, have experience and pass the exam, maybe take some of their courses. So these are very good certifications to pick up. There's also a fairly new one here. It's called Certified in Equity and Intangible Valuations. This is an excellent certification to pick up if you're in the financial accounting valuation part of this. This course, this chapter, talks about valuations for closely held businesses, not publicly traded, but if you're after financial statement, big business, publicly traded company valuations, this is an excellent certification as well. The next point down here, engagement letters. These are so important. You need to make sure that your client, usually the small business or person owning part of a small business, has hired you. You need to make sure that everything is clear. What your duties are, what you're going to provide to that person, what the person is going to pay you. Just many kinds of very important details need to be in an excellent engagement letter. Here are some items. Identify the client. Number 2 here is very important. This needs to be stated in the engagement letter and also in the report we're going to talk about later. You need to identify the specific interest being valued. Usually, if it's a stockholder who has hired you, they might own 10%, 20%, maybe 70% of the stock, who knows. Your goal is usually not to value, well, as part of your goal, but your final goal is not to place a value on the entire company and give it to that person, let's say that minority interest holder. You're to find out what is the value of that person's ownership interest. That needs to be clearly stated. So you're not saying, I'm going to find the value of the company, and that's it. You need to state, I'm finding the value of 10% ownership owned by John Doe or Jane Doe in this company as of a certain date. Number 3 says the date. So look through the rest of this yourself. And you can see there are various purposes for valuations, all kinds of needs for business valuations. That's why I said this is an excellent area that is easier to get into than maybe litigation support in the courtroom for business damages or fraud evaluation. Again, this is not an easy area, but I think it's easier and I think more enjoyable to get into than maybe some of the other aspects of forensic accounting. There are, one thing at the top here. Sometimes you might end up in the courtroom having to defend your valuation. So you need to consider everything we've talked about before and making sure you do an excellent job. Your assumptions can be defended. You can explain what you've done very well in the written report and orally, and be ready, if called upon, to testify in court to say, here's what I did, and here's how I justify it. Very important. There are various types of valuations. There's the asset-based, the income approach, and the market approach. We're going to mainly concentrate on the income approach in this chapter. The others are useful when called upon, and there are different times and places for all these different kind of valuations. Standards of value. This gets down to, again, identifying exactly what are you placing a value on. Is it the entire company? It could be if they want to sell the whole company. Or is it a controlling interest? Maybe it's 51%, 75%, 90%. Is it a minority interest? If it is minority interest, is that interest very marketable, or is it fairly non-marketable? All this plays into the factors you need to consider when you find the value of a specific interest. Fair market value, I do want you to know this. The Internal Revenue Service defines fair market value as the amount at which property would change hands between a willing seller and a willing buyer when neither is acting under compulsion and when both have knowledge of the relevant facts. This is a very common standard definition. Make sure you know it. Things to consider here. If you're trying to find the minority interest value, then usually you're not just taking the value as for the company as a whole. And let's say the minority interest owns 20%. You usually don't take the full value of the company times 20% and there's your answer. We need to talk about discounts because of various factors we'll get into in just a second. Sometimes you need to discount because of lack of marketability. Sometimes you need to discount because of the actual minority interest status itself, as well as lack of marketability. We're going to talk about each of these. So these are very, very important. Now, the extent of ownership interest affects the final value. This is where you start using your judgment. So you need to get to know the company fairly well and use your judgment on here's the value or here's the interest I'm valuing. What factors play into my computations, my assumptions to place a value on that specific interest? We can look at things like how much power and influence does the ownership interest have by virtue of its size and its relationship to the overall distribution of ownership. Is it a very small minority interest, 2 or 3%? Is it a 90% or maybe 100% interest? All that comes into play. Can the ownership interest force the sale or liquidation of all or part of the company assets? Again, that interest you're valuing, what power does it have? And can that ownership interest, number 3 here, declare and pay dividends? Maybe if you're 51% or higher, you can. Maybe the corporate charter says you have to have at least maybe 66 2/3% to be able to declare and pay a dividend for the company. This gets into if you are actually preparing a value for the entire company. You're trying to find a value. 100% of the company, this entire ownership is going to be sold to someone else. You don't have a minority interest. What's the value? It might, in fact, demand a premium. If you're selling the whole company and there's someone else who really wants it more than other people, you know that going in, that could demand a premium. It just depends on a lot of factors. Next page. Here's an example I have at the top. In 2016, Microsoft purchased LinkedIn for $26.2 billion. Well, LinkedIn was a separate company. When this happened, Microsoft paid a 50% premium over LinkedIn stock price just the day before. Why? Because Microsoft really wanted it. And even though the true market value before Microsoft stepped in was running at a certain amount, Microsoft said, I want that bad enough to pay a 50% premium above market. So you can see, depending on who's buying it, how desirable it is for them to buy it. You're talking about some big premiums here. So you don't just look at the 100% value. You could say LinkedIn was, had a market cap of whatever, the stock price times number of shares. You think that's the value. Microsoft came in and said, we'll pay 50% more than that. So again, a lot of factors to consider. What if you have control but less than 100%? Well, is 51% enough to add a premium? A lot of times, yes. In many cases, if you own 51% of the company, you can sort of control decisions. So you might have a premium added because it's an ownership percentage that is more than 50%. But sometimes there could be in the bylaws and so forth that it takes 2/3 or 3/4 vote for something to happen. That would discount a 51% interest somewhat. I'm not saying take out the discount entirely, but it might discount it somewhat. You can look at these yourself. Then we get into minority interest. Take less than 50%. This is where you get a lot of work maybe in your CPA firm. A minority interest holder wants to sell his or her portion of the business. They come to you. What is the value? What shall I be asking for my portion? Because of minority interest, they really don't have control of the business. So when you take the value of the company overall times that minority interest percentage ownership, usually you don't stop there. We're going to talk about discounts in 1 second, but sometimes there's a discount because of minority interest, and there's a discount because of lack of marketability, again, if that's present. But there are cases here at the very bottom of this page where a very small percent minority interest holder could demand a premium. How could that happen? Let's look at the example on the next page. In this case, there are two 49% owners and one 2% owner. So 98% of the business is owned by two people. Then you have that one owner, a third person owning only 2%. You think, well, that 2% is worth very, very little, highly discounted because it's such a low percentage. But think about it. If one of those other two owners get that 2%, they now own 51%. Now it turns them into the majority interest holder, and maybe and probably will have more control of the company. So that situation like here could demand a premium for just a 2% ownership interest. That's why, as we're going to talk about this as we go through this chapter, you have to look at the overall situation. What are the dynamics of who might buy this percentage and why? This just shows you about buy-sell agreements. Sometimes, as a business valuator, you're called in and said, we would like, someone might ask you, we want you to place a value on the business. So you're thinking, well, I'm going to use all these premiums, discounts, income, and all this. But they might say, oh, and by the way, here's how you do it, because there might be a buy-sell agreement. And then really you're just usually conforming just manual calculations, and that's it. So if you're locked into a buy-sell agreement, because the bylaws say if someone wants to sell his or her interest, you must use this formula. A lot of times it's based on book value, which is really usually not good. But you might be locked in and cannot use everything else we're going to talk about in here. It all depends on what's going on around that interest. Are there any limiting factors? Is it a true, let's find the fair market value of that interest, or is it, let's find the value of that interest, but we have to do it a certain way? Next page. Get this turned. Read through this one quickly. This is showing you that the IRS and the tax court suggest that the valuation of flow-through entities should include a premium over traditional C corporation entities. Why? Because with a C corporation, you have income tax at the corporate level. With the S corporations, you don't. So and S corporations that float the entity. Partnerships are also. Read through this, very interesting with the computations here. Now let's talk about some discounts in more detail. If you're asked to value a minority interest ownership in a company, then given all the factors, all the dynamics in that company, what percent is this? Any control here? How much control do the other owners have in the business? You might apply a discount because of lack of control. And that's a minority interest discount. So you might take the value of the company overall, find out whatever that interest is, maybe it's a 5% interest, multiply, but then you apply a discount because it is a minority interest. Very, very small control here, probably lack of control, right? So you apply a discount. Now, the amount of the discount is completely up to your professional judgment. There's no book you can go to that will say, in this situation, we have a 5% owner, we always apply a 20% lack of marketability or lack of a control discount. No, it's your professional judgment. There are various ways you can read through this, horizontal, top down. Those are the preferred. Many factors will influence the amount of the discount that you have to use your professional judgment to come up with. So it's completely up to you. They can range from 21.5 to 30.8%, even more or less than this. But over a 23-year period, that was the average. So again, it takes experience, it takes education, you go to seminars, you take week-long courses, you take exams, become certified, you look at other reports, you have a mentor who helps you with business valuations, and then finally it ends up being up to you to come up with a reasonable discount for minority interest. If you decide there is one, it's completely up to you. This is one thing about this business valuation area is that it is so variable here. I wish, like in other areas in accounting, you can say, oh, here's the way you do it. Here's the situation, here's the way you do it. In business valuations, it's here's the situation. Now I need to consider all the factors. I come up with the method and the discount. Another discount here is the lack of marketability. So in a small company, you might be limited on where you can sell it. There could be a buyback agreement only that states that if I want to sell my stock, I have to sell it to the company. That's my only option. That's an extreme case of lack of marketability, right? There's no market out there. You have to sell it to the company. Or maybe you do have the ability to sell it to the company, maybe right of first refusal. If they don't want it, then you can sell it to the public. But because it's such a small minority interest, it might be a hard time, might have a hard time finding someone to buy it. Lack of marketability kicks in. Again, there are factors. You can look at this. The tax court has come up with these factors down through here. I just talked about this one, restrictions on transferability, hard to find a potential buyer. Or if a potential buyer sees the stipulation that if I buy it, I cannot sell it for 5 years or longer or whatever, that restricts the marketability. A lot of factors, I just pointed out two here. Next page. This is too much for me to read, so read through it yourself. Look at this. One valuation expert in one court case said there should be a 30% lack of marketability discount. Another, the opposing expert, said 75%. Well, the court went with a 30%. So you can get different business valuation experts, of course, apply different factors. This was like more than double, 30 to 75%. So you have to be reasonable. But this is your judgment call based on the factors, based on your experience. So whatever amount you come up with this lack of marketability discount you have to be able to defend your number. Here are my assumptions. They must seem reasonable, and hopefully you can defend those in court if it ends up that far. Another discount that might be considered in a company is a loss of key person discount. And the IRS has its own definition. It defines a key person as an individual whose contribution to a business is so significant that there is certainty that future earnings levels will be adversely affected by the loss of that individual. So let's say that a person selling his or her stock is the key person running that company. If they own minority interest, you might have a minority interest discount. If there's lack of marketability, you might have that discount. And if that person is the key person, you might have this discount to consider. This main person's leaving, the value is going to be hurt overall for this company. So again, read through this. How much that should be, who knows? The tax court in one decision said 10%. Again, it depends on your professional judgment. I do want you to be familiar with Revenue Ruling 5960. It is the ruling that people go to because it's still valid today. I think it's been amended a little bit, but it's still valid today, especially in gift and estate tax valuation purposes, but also in any business valuation purposes. Revenue Ruling 5960, which means it was the 60th ruling in 1959. So it's a long time ago, but it gave great factors to consider when you're trying to place a value on an interest, usually in a closely held company. So you can read through these yourself, 1 through 8. And again, read through this about 5960. It talks about, identifying the nature of valuations. It says no formula can be devised that will be generally accepted to the multitude of different valuation issues. Again, you have to know the business you're going to value in detail. You must consider all the factors. So again, there's no one book, no one page in the book you can go to that will tell you this kind of company, this situation, always use this discount amount. No, it's up to you. Another area where you do find a lot of work in this will be in divorce situations. You need to know state law. Sometimes state law might say, well, in a divorce situation, when one of the parties owns a business, here's what you consider to value that business. So make sure you're familiar with state laws. And to continue with this, make sure that you know how to decide whether it's marital property, to divide it, maybe be divided equally maybe, or is it separate property, stays with one person. Good example to read through here. And also read through this example. I didn't highlight it. This is very good down through here. This pops up in divorce situations a lot of times. You have one of the two parties is a professional, owns a professional practice. How do you divide that equally? Sometimes, since it's not being sold, it's just being kept, the other party is the one that wants a good value on it, and so they want to be paid in the other assets for the value of that business that the owner's keeping, if that makes sense. But anyway, very important issue here. Make sure you read about personal versus practice goodwill. Personal is, it relates to that person. Have it highlighted down here. Practice is just that particular entity. So personal goodwill, the value that person puts in the business. Practice goodwill, you look at the business in general. So excellent topics to consider. I talked about this sort of earlier. There could be someone like Microsoft and LinkedIn. Microsoft is willing to pay a 50% premium over the stock market price because they wanted it so bad. They wanted, WhatsApp so bad. So you have a company that might want to buy its supplier out, so it has more control over the supply chain, right? So again, look at the overall situation, know who the potential buyer is if you're helping a minority interest or any interest, it could be the whole company, wanting to have a value to be the asking price. We talked about buy-sell agreements. They're very common. Sometimes, I guess you can say they're not fair. They might sound great at the very beginning when the company's formed, but here we are 20 years later. If the buy-sell agreement says, find book value, take a percent, that might not be fair. You're not considering fair market value of the assets. You're not considering goodwill. But sometimes you might be locked in, and like it says right in this line here, there's a set formula. So again, you're just doing calculations. You're not using professional judgment. You're just using calculations. So you have to know if there are any buy-sell agreements in existence. Read through the top part of this page. Let's get into common methods that we see in valuing businesses. Discounted future income methods. What you do is project the income for maybe 5 or 10 years or more in the future, and you discount that back to present day dollars. That helps you find a value. Let's go to the next page. Discounted future cash flow. Like it says here, it's very similar to the income method. You're predicting future cash flows in the future and discounting those back. We're going to see some examples about this in a minute, but this is one way. Capitalization excess earnings, not used as much as the others. I just mentioned discounting future income or future cash flow that you estimate in the future back to the present day dollars. Discount. You need a discount percent. Hopefully you've covered this in a finance course. And a lot of times they use the weighted average cost of capital, which we have a formula on the next page, right here. I'll let you read the details yourself, but this will help you get a weighted average cost of capital that maybe in your professional judgment, this is the best discount rate to use. You could have an entire course on just discounts, discount rates. So again, we're just barely touching the service, the area, and so this is one method you can use to find out what's the appropriate discount rate. You might say, I think weighted average cost of capital is the best one to use. You can read through this. Cost approach, don't see that as often. And I want to get down here to gathering some information. It's very important from the very beginning when you're called in to place a value on a business to start gathering information to really know that business in depth. It's not as simple as, oh, just give me your financial statements, your projections, I'll work up the numbers. You need to know a lot of information about that company, a lot of behind the scenes information. This is a very good explanation, this and the next page, about how to and when to acquire information. It says here you might want to gather information, and you really should, before you go to the company and interview it. You'll talk to them. In fact, we have on the next page. It says here, goals of the pre-engagement phone contact. Well, make a phone call. Why? Develop trust and rapport. Gain a brief understanding of the business. Brief at this point, it's going to be detailed in the future, near future. Determine who's going to give me information. If I need something, who at your company will give it to me. You need to explain the valuation process and timing. It might not be a one-day job. It could be a week or two or more. And then you ask the client, how is the best way to correspond with you? Regular mail, faxes, people don't use that as much anymore. Email. If the client is sending you privileged information, confidential information, you need to make sure the client agrees to sending it you in a certain form. If email is somehow lost or hacked, you don't want to be blamed. So have the client tell you how they will send you the information. If they agree to email, you can ask, well, do you want it encrypted or whatever? Again, state, how am I going to get the information when I need it? Next page. Once you get that initial information for the company, then you want to require or request information, again, before your on-site visit, let's put it that way. You'll need to request not only the past financial statements or tax returns if that's all they have, you will ask for future forecasts. Now, for a lot of small companies, they don't have this. You might end up being the one preparing the forecast, which puts more of a burden on you, and that's where you have to really know the company in a lot more depth. If the company is already preparing some great forecast and they have said, we've been on the money on most of these for years, you can rely on those statements, look at it, if they look reasonable, use them. But in many cases, they don't have them. They say, oh, here are my past statements. You need the future forecast. So yes, you look at the past statements, you gather a lot of information, and then you sit down with the company's accountant or responsible person and say, let's forecast the numbers for the next, this is up to you, 5 years, 10 years, or longer. So you request a lot of information before you go to the interviews. You need to look at the statements, as much information you can, so when you finally go for that first on-site visit to talk to the owners, the accountants, whomever, you already know which questions to ask. That's going to be a more efficient use of your time and their time. How much history is enough? This is up to you. Some accountants use 5 years of forecast. Others, this is history, 5 years. They might go back 10 years. They might go back 10 years or more to look for the cycles in that industry. 5 years might not give you a good picture of how that has trended over the years. This is your call here. Once you get financial statements, spread these. This is a horizontal vertical analysis. That's all this is. You look for trends. Percentages sometimes are a lot easier to read than all the raw numbers. Trend analysis that you can help determine with financial ratios. All this should be very, very familiar with you at this point. Look through here. Look through here yourself. And what else do we have? Now let's look at a quick example. Here we have the Fenton Trucking Company, and you need to find a value on this. We have the previous 5 years statements. We have net income across the bottom. I might have part of it cut off here. We have income from operations here. We have other income and loss from sale of assets and other expenses. And then here's the bottom line down through here. This is all historical information. And now you're asked to place a value on this. This method, you've decided, I'm going to just use past information, past statements. That's all I need. Again, a judgment call. In the next example we'll go through, we're going to look at future predicted earnings. You decided in this situation, after you look at all the facts, and we don't have all the facts here, but let's just say this is your call, then use prior financial statements to predict, I should say, to estimate what the value is today. Here are the income amounts. One simple way, and again, remember, we are just touching the surface on business valuations. This is a simple example just to get us started on this. But they said, let's just average the last 5 years. So they do that, add them all up, divide by 5. There's your average income, net income, over the previous 5 years. Fine. Then let's apply a discount rate. One way to get the discount rate, and we talked about the weighted average cost of capital earlier, another way that can be accepted in certain situations is to use the price earnings ratio. And a price earnings ratio here, let's say for this industry, 6 firms that are similar, they have a price earnings ratio of 9-to-14 with an average of 12. So given this limited information, average earnings, average PE ratio, multiply it, there's the value. $3.673 million. A simple illustration, I know, but This is just to get us started. Another accountant might say, well, wait a minute. Equally weighting the past 5 years doesn't do this valuation justice. I think the most recent years should be weighted heavier than the earlier years. That, again, your judgment call. Let's see what the numbers would look like if we do that. Here's how you do it. Let me scroll up a little bit right here. So take the income for each year, weight the earliest year with the number 1, second earliest number 2, jump all the way down here. The latest year has a weight of 5. 5 years, 5 weights, 5 different weights. Multiply across, here's the total. You have a factor of 15 in total, a weighted amount for income, this here, just divide, and there's an average income weighting the most recent years more than the earlier years, 359,000. Multiply that times the PE ratio average, and there's $4.3 million, which is over $600,000 more than our previous example where we did not weight the more recent years heaviest. Again, it's your judgment call on what to use. Some people might say, well, wait a minute, why are we using net income where maybe the most appropriate number is to use operating income? Let's don't consider those gains and losses occurred. They're not part of the regular operations of the business, such as selling those trucks. Used trucks for a while, you might sell them. You might sell your used trucks for a loss or a gain. You think that's not part of the business, let me take that out. You can do that. Again, your judgment call. Now, let's take what we just covered, the same company. Now we're trying to find a value for James Fenton's 20% interest of the voting common stock of the Fenton Trucking Company. So a minute ago we were trying to find the overall value of the company. Now we're being asked, what is a minority interest holder's value in that 20% interest? Well, again, you look at the dynamics of the company, and then you might decide that, all right, need to apply some discounts. The first step is, let's take that latest overall value we computed times 20%. So there is 20% of the overall value of the company. Should we stop there? Probably not. Since we're dealing with minority interest, let's discount it for minority interest. In your professional judgment, after looking at all the factors, you decided, I think I should apply a 25% minority interest discount rate. So what you'll do then is take 25% away. What's left over is 75% of that amount. So we first took the overall value of the company times 20%. That's the percent that James owns. James owns a minority interest. Now let's take 25% away from that. That's what we're doing here, leaving 75% of the 20%. So now we're down to 647, 790. Then you say, well, in this situation, there's lack of marketability because of various factors. I think, in my professional judgment, we should apply a 30% lack of marketability discount on top of the others. And so that leaves, taking away 30%, 70% of the number we calculated here. So now we're down to 453 for James Fenton's 20% interest in the company. So it's not as simple, and that wasn't simple itself when you think of all the consideration, but you don't just find the value of the company and take it times, in this case, 20% and stop. Look at other factors. Should there be a minority interest discount? We decided yes. Should there be a lack of marketability discount? We decided yes in this case. So this is using past information to find the value. We're going to sort of capitalize those earnings to have a value, previous earnings to have a value today. That's one way. In the next example, we have a discounted cash flow method. Here's where we predict cash flow in the future, and discount that back to a present day value. We need three things. We have three steps. Find the free cash flows, and you can see a definition up here. Forecast the cash flows beyond the terminal period. This goes 5 to 10 years, your call. What's the cash flow beyond that 5 to 10 period mark that you first started with, and then discount those back to the present day. Okay. Here are the numbers. So we've estimated for the next 10 years, and this needs to be a very reasonable estimate. So if you're involved in this, you need to work with the company closely. If the company has prepared these, you need to use some judgment here to make sure that their numbers seem reasonable on their estimates. How can you do that? Again, knowing a lot about the company, the location, and the industry. So they've taken each year for 10 years, different amounts each year. And then past year 10, they say, well, for the next 20 years after that, years 11 through 30, we think it's going to be $25 million cash flow per year. So we're going out 30 years in this case, 30 years. They decided to use a discount rate to give us a present value factor of these. You go to the present value tables and multiply across, and this is the present value in today's dollars of all those future cash flows, and there's the value today, $282 million. Balance sheet methods. This is not a very good method to use. Sometimes you're forced into it. The AICPA has a small business consulting practice aid, Valuation closely held businesses, indicates the Internal Revenue Service believes that earnings should be the most important criterion when appraising an operating company. So the use of earnings-based valuation models for valuing businesses is usually recommended. Those are the two examples we just went through. Sometimes, though, you're forced to use balance sheets or book values just because of the buy-sell agreement or other considerations. I'll let you look through this yourself. I know the video is getting a little bit long here. Read through this. Read through this. Just cover a few more things here. I highlighted all this. I'm not going to read through it, but if you're performing a business valuation, you need to make sure you're independent. You cannot be a relative of one of the owners here. You cannot do that. Your fee cannot be contingent on the amount you come up with. Again, it gets away from independence. You need to know the limiting conditions and state those. You need to list in your report the individuals who materially participated in the valuation process. You need to include your sources used, and then you need to know what the report should contain. The next couple of pages has item after item that should be in the report. So just look at all these. Standard of value. All these are important, but you need to be clear in your engagement letter and in your final report and specify, this is exactly what I'm valuing. I'm valuing Jane Doe's 10% voting common stock interest in XYZ company as of a certain date. That needs to be stated clearly. All this needs to be in the report. Each of these, read through each of these, everything needs to be in here. The reports can be quite long. There is an example I have in Canvas on a report. Again, we're still going through the report here. And that one example is 53 pages long. That's the report. So there is a lot of work involved in business valuations. There's a lot of work involved in preparing a full, complete report on these. They go 50, 60, 75 pages long sometimes. You need to state everything in that report. Everything you considered. Again, be specific about the interest, the date, the intended use of this. Just all kinds of items go into that report. We've talked about testifying in the courtroom earlier chapters, and so nothing new here. Again, you need to make sure that you are ready to testify. I know this is a long video. Hopefully it was informative. Here we're at the end of the chapter. So again, as always, good luck with your studies.